So if we could just get the guys up here for the best ideas from other markets. So we've got Sarah Shaw, Global Portfolio Manager and Chief Investment Officer at 4D Infrastructure. So just a couple of points. So she's up to a 2-year track record, top quartile performance, number one over the 1 year, just in the Morningstar survey that came out today. So Sarah, I'll pass over to you. Just added to a couple of platforms in the retail space, but over to you for your best ideas. Thank you.
4D Infrastructure is a listed infrastructure fund. We've already heard today that's a little bit out of favour at the moment, the so-called bond proxy trade. So before I get into a couple of our best ideas, I just really want to spend a couple of minutes explaining why we're still positive on infrastructure, even in a period of synchronised global growth or one of rising interest rates. Infrastructure is a defensive asset class. It's got the characteristics that support long-term visible earnings and a solid yield. We like that about infrastructure. However, infrastructure offers you this defensiveness with huge growth upside as a result of a growing need for infrastructure investment globally. This defensiveness plus growth, as well as the diversity of the asset classes and the geographies in the infrastructure space, means we believe you can position an infrastructure portfolio for a period of synchronised global growth and rising interest rates. As we see it, infrastructure offers you two very distinct and macro-diverse subsectors. On the one hand, you have your essential services. These are your regulated utilities in the water, gas, electricity space. These are the assets that are really immune to macro cycles, both up and down, as a consequence of them being a basic need, as well as the structure of their regulatory environments, which measures returns independent of volumes. These are the assets that are bond proxy in nature, and they are a really attractive overweight position in depressed macro environments. That's not where we are, and we are significantly underweight these sort of assets. On the other hand, you have what we call a user pay assets. These are your toll roads, your airports, your rails and your ports, including Transurban. These assets should not be considered to be bond proxies. We believe that the earnings of these assets are not fixed and in fact have a direct positive correlation to GDP growth, inflation and interest rates. These assets represent a really attractive proposition in periods of synchronised global growth and rising interest rate environments. This is where we are really overweight at this point in time. The other aspect to infrastructure is that it is truly global. You get exposure to developed Asia, Europe, North America, as well as emerging markets. This allows investors to access in-country macro cycles, as well as gaining exposure to domestic demand stories. Since late 2016, we've been in a rare period of synchronised global growth, with interest rates and inflation moving up. With that as our macro backdrop, and given the diversity that we have within the infrastructure space, we've been significantly overweight user pay assets, very underweight regulated utilities, and overweight particular themes, including the emergence of the middle class and the One Belt, One Road policy coming out of China. In that sort of environment, 4D has actually managed to give you double-digit returns over the last 12 months, like high double-digit returns. So that's how you can position infrastructure, even for a period where you're seeing interest rates rise. With that as the sort of macro backdrop, I just touch on a couple of our best ideas, which will hopefully clarify how you can gain this exposure. The first is GetLink. GetLink is the former Eurotunnel. It runs the Channel Tunnel between UK and France. It offers shuttle services, it offers freight operations, as well as providing the infrastructure for Eurostar. It is a perfect example of a pure play user pay infrastructure asset, exhibiting all the characteristics that we want from infrastructure. You have a very strong long-term contract in place with significant capacity available to support volume growth. You have a unique monopoly asset which has competitive advantages over its peers in the air and the ferry space, and you're seeing this being captured by a market share gain. It has pricing freedom on its shuttle operations, which means it can continue growing earnings even once we sort of reach those capacity limits. It can actually balance pricing with volume elasticity. It has its own individual growth drivers. It's basically capacity utilisation, optimisation. We've got new Eurostar routes opening all the time. London to Amsterdam opens next month. And it has dividend support. Dividend in 2017 was up 15%, with management guiding that you're going to continue seeing dividend growth in line with free cash flows. We have to balance these, I guess, what we call strengths against a couple of the risks to the model. And the first one of those is it's a single asset. So you've got single asset dependence. You've got some currency risk. And in the shorter term, you've got the Brexit overhang. But we really think that the strengths of this asset definitely outweigh the risks at the moment. And investors will gain exposure to a really high-quality user-pay asset that's geared to the macro cycle, and it's significantly undervalued at the moment. The second theme I just wanted to touch on today, or our best idea, is our global overweight to airports. One of the key drivers of the need for infrastructure investment globally is the emergence of the middle class in developing economies. It's driving the in-country domestic demand stories as well as the global need for infrastructure. At the moment, 5% of Chinese nationals currently own a passport. Yet, we're seeing record numbers of passengers at Sydney, Auckland, Paris, Madrid, Bangkok airports driven by the Chinese traveller. By 2025, the estimate is that we will be welcoming 3.2 million Chinese visitors a year. That's up from 1 million today, and that's going to be 26% of our total inbound traffic. It's the emergence of this middle class that is a big reason that we advocate truly global exposure in any infrastructure portfolio. We just think the emerging markets are too important to continue to ignore, and they are going to be a huge driver of global growth for decades to come. If you take China, India, Indonesia, they make up 40% of the global population. So what happens in those economies is really going to drive forward what happens in global economies. Just taking those three countries as an example, and I think Sanjeev touched on it earlier, China is expected to displace the US as the #1 aviation market by 2024. That's measured by traffic in, out, and within the country. In 2025, India will displace the UK for third position, and Indonesia will displace Italy for top 10 ranking. Over the last decade, we've seen emerging markets' share of global passenger traffic increase from 26% to 40%, and that's a trend that's just going to continue for decades to come. Hopefully, these stats really just highlight to us the need for global airport infrastructure and the earnings upside for those operators that are willing to invest. So 4D are actually very overweight airports. We have exposure to airports in the Americas, Europe, and Asia, in both the developing and the developed world, in order just to capitalise on the emergence of the middle class. So hopefully these couple of ideas will just give you a little bit of colour on how we think you can position a portfolio, an infrastructure portfolio, for a rising interest rate and a strong macro environment. Thank you.
Thanks, Sarah. Obviously a key differentiator with her portfolio is that EM tilt in infrastructure. Next speaker, we've got Justin Blaze, Principal and Portfolio Manager at Key Global Investors. Key is also one of the newer boutiques with Bennelong, but it's got a 3-year track record up and running. They've got the recommended with Lonsec. They've just got, in the survey again today, they've #1 over 3-year track record in the G-REIT sector. So well done to the guys, and they're up for an award at the Money Management Awards, Lonsec Awards, for G-REIT category and for Emerging Fund Manager of the Year. So well done to the guys. So a few minutes. Thanks, Justin. I'll get you to give your best ideas.
I'm going to, before I talk about an idea, I just want to also, address interest rates and some of our thoughts in relation to global real estate, also how we think about that in relation to our process, and then I'll segue into what we think is a good idea at the moment. Obviously, we're in the midst of a tightening cycle by the Federal Reserve, and for those that weren't aware, during the last tightening cycle from 04 to 06, global real estate actually delivered strong, absolute and relative returns to global equities. And the reason interest rates are going up is obviously because the expectation is that inflation will rise, and inflation is actually good for real estate. Rents are often linked to inflation, and then rising construction costs mean that obviously higher rents are required to justify supply, therefore elongating the cycle and providing pricing power to the existing landlords. For those that aren't aware, global real estate is actually a long-term outperforming asset class. So the recent underperformance that we have been seeing as a result, arguably, of rising interest rates, we think actually represents an excellent opportunity to enter the sector. And the reason global real estate is a long-term outperformer is quite simple. Land is a store of wealth. Land doesn't suffer economic obsolescence. The cycle is long, interest rates have been low, and whether it's been a result of low interest rates or whether it's been a result of central bank stimulus, there's no doubt that in parts of the world, certain sectors and segments do exhibit high valuations relative to historic norms. And an example of that is London office. The way we seek to manage that risk is by focusing on replacement costs. So we look to identify a select group of investment opportunities at or below replacement costs as our valuation anchor, thereby providing some protection against the inevitable cycle when it does occur. We also think about our investment opportunities as business, and like Neil talked about, we're looking for real estate owners that operate as well-run businesses, so we want low payout ratios. We want focused strategies, sector specialists and good management. But we're also looking for earning stories that are assisted by long-term themes. And an example of one of those themes that we like is US multifamily, or apartments for rent is what we call them here. And some of the characteristics of that sector that we like, on the supply side, US residential construction still remain well below pre-GFC levels. As a result of the GFC, home ownership rates remain at 50-year lows. And renters as a percentage of the housing stock continue to rise. And most of those renters, the number on that chart on the left there is, for multifamily, is 86%. So there's a good supply dynamic, the demand story is very robust, and those renters will go into multifamily in most instances. And a stock we like exposed to that space is Essex Property Trust. Essex Property Trust is listed on the New York Stock Exchange. It owns approximately 60,000 apartments along the west coast of the US in Washington State and California. In addition to the favourable the themes assisting it that I talked about previously, being West Coast exposed, they're experiencing stronger wages and salaries growth. But the valuation point is quite attractive. Coming back to how I talked about replacement costs, the implied price per unit for the stock at the moment is about $380,000. We know that they're building new supply at 600-odd thousand. So that makes us feel good about the valuation price point, particularly when we consider that in light of what we think is a good long-term growth profile. So in summary, rising interest rates isn't necessarily bad for global real estate. Global real estate is a long-term outperforming asset class, and it offers exposure to some attractive themes that generally you can't get in this market. Thank you.
Thanks, Justin. So next speaker, we've got Alistair McLeod, Managing Director and Portfolio Manager from Wheelhouse Investment Partners, the newest boutique here in Sydney. Alistair came out of Wingate, and he brought a team across with him from one of the big hedge fund groups over in London. Brevin Howard was the name of that one. So he's running a global equity income fund, which really is focusing on protecting that downside risk. So I'll pass over to Alistair. Thank you.
Well, speaking last, it's a blessing and a curse, I think. The curse is that I think everyone's had enough of stock stories, and the positive is we don't do any stock research, so I don't have any stock stories, so this will be short. The blessing is I can lean on everyone else who's already spoken and cherry pick from their presentations, much less speaking last at the debate, and no one can really challenge me on it. So, but the focus of today is going to be on defensive growth. What is defensive growth? And for us, it's an income-driven equity return. Okay, interest rates. So I'm borrowing from Neil and pretty much everyone else today. This is long-term, this is US market, long-term US bond rates. And the blue line, the light blue line is valuation. This is the Schiller PE, so it uses 10-year real historic earnings. And the couple of things on this market, I mean, you can see the clear inverse relationship. You can see that from a valuation perspective, it's the second most expensive market since pretty much the American Civil War. And the other dynamic in this is how long-term in duration these interest rate movements are. Interest rates, the secular trend has been 35 years of declining interest rates. Ever since 1981, Volcker started cutting rates, he tamed inflation. There's been bumps along the way, obviously the tech wreck, the GFC, which was cyclical, the GFC, which was structural and cyclical, but these interest rates move in glacial fashion. And pretty much as an asset, you had to be nailed to the floor to not be going up in that sort of an environment. And probably it's no surprise that towards the end of it, you've seen this massive rise in passive in ETF investing because you just needed to be an asset and you pretty much went up. The other thing that I'd highlight on this chart is that in this glacial movement of interest rates, if you look at when interest rates were going up, again, it was glacial. From the mid-1950s to 1981, it was a 25-year period where rates were going up. And you look at corresponding valuations were going down. Now, in that period, does anyone know in the 1960s what the S&P returned in real terms? It was about 1.8% a year for 10 years. Including dividends, it was about 5%. This is real. In the 1970s, the return on the S&P was negative 5% a year for 10 years. Including dividends, it was about negative 1.4. So you had a 20-year period in a secular bear market where equities delivered you around 2% real. Now, if you think about that from a retirement construct, you're in retirement for 20 years, 25 years, and you're entering retirement in 1960. Now, your advisors, what's typical redemption rates for a retiree? It might start at 4%, 6%, 7% redemption rates. When your investment returns are less than your redemption rates, your capital base gets eroded exponentially. And I think when we were putting together our business, we wanted to deliver real growth in that sort of an environment. Now, how do you do that? If you're an excellent stock picker and you can pick CSL and you can pick airports, you can deliver real growth even though the market isn't moving. And I think you'll see a return to active management going forward. Our approach is a little different. We run a derivative overlay on a concentrated portfolio. And the purpose of was two purposes. One is the parachute, but the other purpose is to change that mix. Typically, equities give you 2/3 capital, 1/3 income, and we're delivering 2/3 income and 1/3 capital. So it's defensive because if markets do nothing, we're still generating around 7% return on income, which is your return in a sideways market. If markets go down, well, they have to go down by 7% before we start losing money. But it's still, and that's the beauty of an income-driven return profile. The next slide, I want to make the distinction between a Telstra or a bond proxy, which is paying a big dividend, but there's no growth. Now, as you can see from the portfolio, there's genuine growth in the portfolio. In our tech exposure that I've highlighted there, revenue growth is 20%. It's actually about 14% compound for a lot of those names the next 10 years. None of those companies are paying dividends. But because of the overlay, you're delivering that income on a very diversified sector exposure. And in fact, we own none of the typical high-yielding sectors like utilities or other infrastructure assets. So to put it in, this is again how an income-driven return performs in a more of a lower growth environment. This is over the last 30 years. You can see that the return over that 30-year period is the same as the S&P. It's still an equity return. You're not foregoing growth. You're not foregoing return over that period. It's just that it's delivered in a different fashion. And it's delivered in a fashion that does particularly well in a weak market or a sideways market or a more highly volatile market. So that really comes to where do we fit? Because, in our definition of defensive growth, it's income-driven growth. It's still growth. When you think about it, from an asset allocation decision, you're not moving to cash. You're not trying to time the market because it's still delivering you that equity return over the long term. It's just in a different shape. Now, the chart on the left is a typical asset allocation model, maybe right or wrong with what a lot of people have. If you introduce defensive growth to that portfolio, you do a couple of things. Firstly, you're increasing your income generation. Secondly, in a sideways market, you're increasing your return expectation. And finally, from a volatility perspective, our beta is about 0.65, so you're not changing that volatility of the portfolio at all. It's just changing the shape and how it's delivered.
Thank you very much. Thanks, Al.